In this video, we're going to have a look at P&G, Procter and Gamble, one of the biggest consumer goods giants in the world. They own brands like Pampers, they own brands like Braun or Gillette or Always or Tidepod, Ariel. They own a lot of brands. Here is a list of some of their more famous brands. Procter and Gamble has been around for almost centuries at this point. It's a very old and established brand, and of course for that reason they also trade at a premium. So let's have a look at their financials. Let's see whether or not we think that Procter and Gamble right now is a good investment, and if we hold it for a decade, can we expect to outperform the market? So looking at the revenue here, I think the first thing that we notice here is that their revenue is down from 2013 all the way to 2017, after which their revenue started to pick up again. So from 2017 all the way to 2022, their revenue numbers have been increasing by about 2% every single year. Overall, throughout the entire 10-year time span, however, we basically saw no movement in their revenue, but I think we can expect some revenue growth here in the future considering the past 5 years of growth that they did have. Their EBITDA is telling pretty much the same story. We see a EBITDA of about 17 billion in 2013 and it's just about 20 billion in 2022. Now you might notice here there's a bit of an outlier which is very much away from the norm of the usual growth trend that we do see here in 2019, but this is mostly an accounting change. This was because of goodwill and indefinite-lived intangible charge, which basically means that the fair value of their goodwill and intangibles, which is basically your brand, how well known is your brand, how much loyalty do consumers have with your brand, and the fair value of their goodwill was a lot lower than they said it was on their balance sheet. So of course, to compensate for that, they had to reduce the earnings there. So even though it does say that the EBITDA here is 8 billion, they actually made quite a lot more money, but they had to compensate for the decrease in goodwill. So take this number with a grain of salt, it's purely for accountancy reasons. Overall, we see a growth of about 2% in EBITDA for the past 10 years, which is not a lot, it's really not, but it's a very stable company. Their debt level has been increasing by 1% every single year. Of course, they can't really leverage up too much because their earnings pretty much doesn't allow it. So I think it's very nice, a nice and safe number here of between 30 to 33 billion in debt. They also, of course, always have some additional cash on hand. If push comes to shove, they can pay back part of that debt, but of course they can also acquire additional brands, which is something that they have been doing a lot in the past as well. Market cap for the past 10 years has been increasing by 5% every single year, which is really nothing to write home about, but it's a very steady number nonetheless. Enterprise value has been increasing by 4.6%, relatively in line with market cap. So looking at the multiple that we have here for Procter and Gamble, we see a low point of about 14 times in 2018 and a high point of 36, but do remember that this is mostly because the EBITDA here was very low. If we normalize this again, we see a pretty normal trend of around 15 to 19 times EV/EBITDA ratio. Net debt to EBITDA has always been around the 2 times mark, which is very stable, very nice, no risk of bankruptcy whatsoever, which is very much what we like to see. So this then brings us to the cash flow statement. So looking at their cash flow from operations, we see that they've been steadily increasing their cash flow by about 1% every single year. And cash flow from operations is basically all the money that's left at the end of the year. It includes the wages for employees, it includes the materials, it includes the manufacturing. Everything that's required to run the business for that year is included in this number. And at the end of the year, they have a cash flow from operations between the 15 and 17 billion. Capital expenditure is basically all the expenses that they have to make to keep on running their business in the future. It's a new brush of paint, it's an additional acquisition for a plant, it's additional company cars, it's everything they need to keep on running their business. So if we take the cash flow from operations and we subtract the capital expenditure, we get their free cash flow. And this is basically your pro rata ownership of the company. This is all the money that's available to reward you as a shareholder. Of course, what they can also do with this money is buy back debt or do additional acquisitions, which is also something that they do. But additionally, they also use it to pay a dividend and buy back shares, as we can see in the next column. Because for the past 10 years, they've been reducing their share count from 2.9 billion to 2.5 billion. They have basically took 400 million shares out of circulation and ripped them up in your benefit, which means that your pro rata ownership of the company, your percentage ownership of the company is increasing without you needing to buy additional shares. So of course, because the free cash flow is increasing and the amount of shares outstanding are decreasing, this gives a very exponential effect on their free cash flow per share. We see $3.91 in 2013 and around the $6 mark here in 2021, 2022, an increase of about 3% every single year. The price per share has been increasing by 6% every single year, starting at around $80 in 2013 and ending at $140 in 2022. It's nothing spectacular, but it's very consistent and very steady. Free cash flow yield overall for the past 10 years has been around 4.8%, where I think recently the norm is more around 4.5%. So let's see if we can forecast Procter & Gamble into the future. First of all, we start with the enterprise value model. So we see here that EBITDA has been steadily growing for the past 5 years by about 2%, this column, for about 2% every single year. So I'm going to give them this 2% growth here for the first 5 years, which is a growth that's in line with inflation, and I do very much expect them to reach this number. Afterwards, however, because I want to be a bit more conservative, as I always am, I expect that EBITDA growth to kind of decrease to 1.5% every single year. Additionally, I'm going to attach a 16 times multiple. Like I mentioned, the moment that you normalize this number, we can see that on average they've been ranging around the 16 times. And I think 19 times is definitely a bit overvalued for a company that has basically no growth in their earnings. So I actually expect their market multiple to kind of come down, to contract a little bit, which is definitely not in our favor as a shareholder. So if I take this multiple, I get an enterprise value of about 392 billion. From which we subtract the debt, we add the cash, gives me a market cap of 366 billion. Divide by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. Of course, it's very well possible that this does not happen and they keep on buying back shares like they have been for the past 10 years. And because I can't really use their free cash flow in this model, I'm going to remain it the same. This gives me a share price 10 years from now for Procter & Gamble of $144.36. And for the free cash flow method, we're going to do a very similar thing because I think their free cash flow has been growing kind of in line with their EBITDA. So I'm going to grow their free cash flow by 2% every single year and then grow it by 1.5% for the last 5 years. Now, of course, their free cash flow per share has been increasing by 3%, but this number takes into consideration the fact that the share count is decreasing, which I don't want to do in my assumptions. So with this growth, I'm going to attach a free cash flow yield of about 4.5%, which I think is the average number they've been at for the past 5 years. And this gives me a share price 10 years from now of $142.38. Right now, on the open market, I can buy as many shares as I want for Procter & Gamble for $152.22. Taking both our projections and cutting them down the middle, we get an average share price 10 years from now of $143.37. Simply looking at the share price on the stock market alone, I expect the share price to come down by about 0.6% every single year. But the moment that we include all the free cash flow that we expect to receive in the next 10 years, as projected in our free cash flow model, I expect an IRR, an internal rate of return, of 3.9%. On average, I always say the stock market returns about 10%, and I think given these numbers, I expect Procter & Gamble to heavily underperform the market in the next 10 years. We have seen a major correction in tech stocks and any growth companies here for the past 2 years, but Procter & Gamble, surprisingly, their share price has been going up because of course they are producing essential goods. And their revenue numbers and their EBITDA numbers does not take a hit because whether or not there are economic headwinds or tailwinds, Procter & Gamble will be able to sell their products because everyone needs their care products. And I think for this reason, during the last market downtrend, most people flocked from growth stocks to value stocks like Procter & Gamble because they are considered more safe. And I think because of this, Procter and Gamble has not seen a correction, but instead seen a growth in their share price. And I think the growth has come to an extent where I expect Procter and Gamble to very much underperform the market, because I think right now it is quite overpriced. So let's see what happens if the price goes up or comes down. The moment that the price of Procter and Gamble comes down by 30% back to a price of $110, I expect an IRR of 8.7%, which is still very much underperforming the market. But given its consistent numbers, I think at that point I might be a little bit interested in looking at Procter and Gamble. But up until this point, at the $152 price range, I am definitely not interested in Procter and Gamble. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio!